Awesome. Thank you everyone for joining. We're so excited to kick off here. Today, based on a lot of requests we received from people, from prior attendees and prior events, we have Liz Wessel with us here from First Round Capital. We're really excited to have Liz here. Before crossing over to the investor side, Liz co-founded WayUp, scaled it to 7 million users, raised $40 million, and exited the company in 2021 after nearly 8 years as CEO. She's also been a visiting group partner at Combinator and has been an active angel investor and was named to the Forbes Media Brink list last year. We've gotten a lot of requests to have Liz on the show here, and so we're really excited for that. Alongside Liz, we also have a special guest today who's going to be joining at the very end. Boardy AI is a super connector that is known for connecting founders with customers, investors, and talent. And Boardy has actually spoken with hundreds and thousands of founders over the past year, and so really excited to see the thoughts that Boardy has to contribute. We will dive right in. My introduction. So my name is Gul. I'm the founder and CEO at Metal. Metal is an AI native operating system for founders that are raising venture rounds. Fun fact, my previous startup that I started in 2019 was backed by First Round Capital. And so it's terrific to have someone from First Round be a part of the series. Thank you everyone for joining. We'll dive right in. So Liz, welcome. I'll give you a moment to just introduce yourselves in your own words, and then we'll dive right in.
Sure. I think you covered it, but yeah, I'm a partner at First Round, investing as a generalist investor, so across every single category from, software to robotics, vertical to horizontal, and everything in between. I guess I don't do biotech or crypto. And we focus mostly on US based companies, but that's me based here in San Francisco and really grateful to be on. So thanks for having me.
Awesome. Liz, I guess we'd just love to start off with your experience. I think you have the benefit of being a founder and, in the not too distant future,
Yes.
not so distant past. And so we'd love to hear a little bit about, how your experience of building a company inform or influence how you look at investment decisions. Is there a specific vantage point that, your prior experience of starting a company, being a founder, raising capital, being on the other side, going through everything that founders go through, how does that inform or influence how you look at investments now?
Yeah. Yes, I did spend the vast majority of my career as a founder and CEO. I was the co-founder and CEO of a company called WayUp, which I ran from 2014 to 2021 until our exit through M&A in 2021. And so definitely I have a lot more years as a full-time founder than I do as an investor. Um, But to answer your question of how being a founder influenced me as an investor, I would say it really impacts me in how I help founders. Um, I won't pretend I have a perfect view of how to invest or how to pick, if you will, just because I've been a founder before. I think it just helps a lot more on the helping side. But I will say, any founder, that pretends to like know everything when they're pitching me, I think maybe I have a little bit more of a BS detector than some investors because I've like been there before. And then I also think because I'm a former founder, I often find that founders who are pitching me maybe tend to open up a little bit more to me just because I've been there before and in their shoes, obviously with a very different company, but yeah, in general, I think it helps me a lot more as an advantage, if you will, when it comes to helping.
Right. And, I think over the years, one of the things that's becoming particularly well known now is, how there is such a thing as like founder partner fit, right? Where, different
Yeah.
partners gravitate to different types of founders and they have, different sectors that they're more excited about and some areas they're less excited about. I guess what are maybe, you mentioned you're sector agnostic, but what are areas or what are founder characteristics or what is your sweet spot?
Mhm.
What gets you really excited in a first conversation with the founder? What are things you look for?
Yeah. Okay, so I would say first and foremost, like 90% of what we invest in, because our name is First Round, we tend to do, either pre-seed or seed. We do a little bit of A, but for the most part, it's 90% probably, if I had to guess, of the investments we do are maybe even a little more than 90% are pre-seed or seed. And That means that it's everything from the founder is still in their prior job thinking about a new idea to the founder has started working on it and maybe has their first few customers. And so it's really, really early. And so like 90% of what we're investing in is the founder and underwriting the team as opposed to some traction or something like that. So a lot of what I look for in the team are that they are so unreasonably deep with the customer, that they are like so obsessed with this problem, and that they have almost some unique insight, whether it's because it's from a former job that they had or a prior company that they were running, or maybe if they're right out of college or even a college dropout, maybe it's like they were a barista, they wanted to work on some problem that affects coffee shops or liquor stores and or whatever it might be. And so they decided to go work at a liquor store for like, months or talk to 250 liquor store owners or some like that they basically went unreasonably deep in really understanding the problem that they're solving. Um, and that they were able to come out with some unique insight. And so that's a lot of what I look for. When it comes to markets, I do have a soft spot or a sweet spot for founders who are changing, super old school markets. I won't lie. That said, I also love investing in, some new categories. I just most recently did an investment. It led an investment in a company that's selling into data centers. So it's obviously that's not a 200-year-old industry, but uh, yeah, I really tend to be a little more market and product agnostic and a lot more focused on the team because it's so early and so much can change, of course.
Right. And I think, you've mentioned a little bit about how early, first round is investing pre-seed seed. What is sort of the upper end of that? Is that, is that like seed stage companies doing a few $1 million in ARR? Is that the upper end, or what does the upper end look like,
Yeah,
particularly for your
I've
investment?
seen us do a couple companies that might be doing something like that, but for the usually most of our investments are either pre-revenue or maybe they have a couple design partners or a couple customers. Like the vast majority of our customers or of our portfolio companies do not have customers that are doing nearly that kind of volume.
Awesome. And just taking a step back before we get back into investing, I think what's particularly interesting here is your background, and I think this is a big part of why we've gotten so many requests to have you as part of the podcast. I guess what are things you would have done differently during your way up raises? When you were raising capital, now that you've seen a very large number of founders, you've spoken with a very large number of founders, you're constantly talking to founders. I guess what are things you now realize, or things maybe you would personally do differently if you were fundraising again, going back to your first company?
Oof. I mean, honestly, when I joined First Round, probably the biggest reason that I joined First Round was because it was the type of firm I wish I had had on my cap table as a founder. And you've experienced it because we were on your, it sounds like, your prior company's cap table, but like all of us partners, investing partners are former founders. I didn't optimize for having investors on my cap table who were former founders at all. And I wish I had. To be clear, I'm very grateful for the investors I had. I had a great team of investors backing my company WayUp, but I did not have on my board or really mostly any of my major investors like former tech founders. And I think that was a huge miss, especially early days. I think a lot of founders think about like specialist investors versus generalist investors. I think as the company gets later stage, specialists can really help on the investing side, but especially at the pretty early stages, a lot of getting up and running in that 0 to 1 is like a lot of the basics, whether it's hiring, whether it's pricing, whether it's getting your first 2 or 3 customers. You don't need a Rolodex of 10,000 customers to do that. And so I wish I had had former founders who'd been there and who could have been super blunt. I also don't know that I optimized enough for investors who are just so incredibly blunt with their feedback. Like one investor that I had who was the definition of that, who I love, I still love today and loved back then, David Tish from Box Group. He would just like say it like it is when it comes to feedback. And I really valued that. And I try to bring that to all of my founders. We have a phrase at First Round where we say, We're going to give you our unwavering support and our unvarnished opinion and our unvarnished feedback. And so, what that means is we're always going to support you. But when you're screwing up, we're going to tell you when we think you're screwing up. Now, if you decide, hey, I disagree, I'm not screwing up, I'm going to go with this anyway, great. We support you. You're the founder, you know best, and we could totally be wrong. But we are going to make sure you have that feedback. And I think a lot of investors out there are just cheerleaders, especially in the early days, and they're not giving that feedback. So, I wish I had had a little bit more of that on my cap table and on my board level of like partners who, yes, believed in me as a founder, but also who were going to be fully honest with me, hold me accountable, push me to be the best founder. And I think a lot of that can often come from people who've been in those shoes before. So yeah, especially at the early days when like, scaling or figuring out your IPO strategy is not quite the thing you're focused on.
Right, right. No, absolutely. And I can attest to that. I think first round attracts some of the best partners, and I think it takes a particular type of firm with a particular set of ethos to sort of really lean in and pay attention and to sort of really care about the companies and not just look at it as an index business.
Yeah.
That's great. Um, I guess just switching gears here a little bit. You're part of Y Combinator before you ended up joining First Round full time, and so you've been investing for some time. I guess any instances of passing on impressive founders where you were on the edge, and maybe a little bit of remorse looking back, or like I really should have pulled the plug on this. Any learnings, insights from investing experience?
Yeah, I mean, I've been angel investing since 2016, I think. One of my first couple angel investments when they were still in the YC batch was Scale AI, and then I was seed investor in Ramp, and then several more since. And then, of course, worked at YC as a visiting partner, and then at First Round have made many investments. So I've definitely made no shortage of mistakes over that last 10 years of angel investing or full-time investing. I'll start with just the ones that I don't necessarily regret, but where like the founders got 10 term sheets from the who's who and I passed on that investment and I don't necessarily regret it are some of these founders where they have like impressive logos, just incredible LinkedIn profiles. But when I dig deep with the founder, they don't have that nuanced, deep understanding of the problem or that nuanced perspective on an approach. And so I think that that has been one of the things where a lot of venture will like throw money at like, oh my God, you were, youngest employee on the Google this team or whatever it might be. Like, I got to give you money. And it's like, yeah, you might have been an amazing employee, but are you an amazing founder? I think those two are very different things. Um, so I'll start with that. On where I've made mistakes. There's especially over the last couple of years, there's a phrase, I don't know who came up with it, called tar pit industry or tar pit categories, where people say, listen, there have been hundreds or thousands of brilliant founders who have tried to start companies in this category, and you cannot have success with it. And it's called a tar pit because like it literally is like from the, very, very, very long time ago where there would be pits of tar and no matter how big of an animal could go through it, you're going to get stuck. Kind of like quicksand. You're gonna die. And there were some pretty classic tar pit categories. Legal tech was a really big one that a lot of investors would have told you, not venture scale, no, no way. And then Harvey came along and completely proved that wrong. And a year or two or however long later, Legora was the second use case. I think ed tech is a really common one that a lot of investors are like, don't go near me with your ed tech. It's tar pit. So then it begs the question, well, what's different now? And it might be AI tailwinds. It might be, meaning that there's finally something you can unlock that never was possible before. Maybe it's market tailwinds in some cases. Um, um, there's like in the selling into hospitals. There's a lot of things going on right now that coming out of COVID, hospitals are needing to cut costs tremendously. You're starting to see some categories that really historically prevented companies from reaching epic scale and now they are, no pun intended there. So anyway, the point being, I think that's probably a place that I've made mistakes. I like to say like no matter how great of a founder you are, let's compare it to like fishing. You could be the best fisherman or fisherwoman fishing person in the world. If you are fishing in a pond with no fish, you are going to come up empty-handed. And you can be a pretty crappy fisherman if you're fishing deep in the ocean where there's just like no shortage of fish that are desperate for worms, you're going to catch something. And so I look at it similar to markets. Like you can have an epic founder, and if they're in a really tough market, it doesn't really matter. So I've also, the flip side of your question is I've made mistakes in investing before where I've said, yeah, this founder is just epic and I fully believe in them. Even though this market is just so awful and the customers are so awful, if they're, that's kind of the equivalent of them fishing in a pond with no fish. And then you kind of hope that they're going to figure it out quickly enough and be as epic as you hope and be like the stewards of Slack of the world, where they're going to say, okay, let me pivot away from this gaming company and switch to building what, was eventually Slack. But that's very rare that you see founders do that.
Right. And I guess, one of the questions that it prompts is like, you know, are there specific reasons for what keeps epic founders in, not so exciting ponds? Like, how does that come together? Especially if you're an epic founder, you're paying very close attention to obviously your market and you're deeply knowledgeable about it. I guess, what leads some great founders to sort of not see, the pond that they're in?
Yeah. And unfortunately, I've had like a front row or second row seat to watching founders go through this before. I think one of the things is often them saying, okay, I think it's just that one more product. Like the most common you hear is it's just that one feature we're missing. We're just missing that one feature. And it's like, oh, but if we just launch this one feature, then we're going to get all the customers. Or they're not actually reading the room of what customers are saying and they think they are. And so the customers are telling them, because why should a customer say we're never going to buy this product, even if they believe that one day they will? Especially if it's like a more junior person who doesn't actually have the decision-making capabilities and so on. At the end of the day, unfortunately, founders are going to be told at times, oh, we're really, really close. And they could be strung along on a deal for 9, 10, 11, 12 months, and they're just going to keep believing. So sometimes it's a matter of they're listening to customers that they actually shouldn't be listening to. Sometimes, and they're not hearing what they should be hearing. And so they're hearing what they want to hear. Sometimes it's just this false hope of like, oh, all we need is that one more feature. Um, and then sometimes it's just maybe they are a little bit too early and they're right about the market. I've definitely met founders before who actually were right about the market and they were just like one step too early and they needed a little bit more in the market to change. We've certainly seen that before. There was like an entire iteration of DoorDashes and Uber Eats that existed well before DoorDash that just never took off. And then, you have to be kind of right time, right place, and right team. And a lot of founders will never be willing to admit it's just the wrong team.
Right, and also sometimes you're so invested in that category. You've been sort of working on it for a long time, and there's something as incumbency bias, and you're right. Like there's so many vectors to it, right? Like there's timing. It could be the right idea, just not the right timing. There's the idea itself. There's customer feedback, and not all customer feedback is created equal. I guess just switching gears here, Liz, what is if, between like a founder who's talking to investors and one of the things that's interesting is sector specialization, right? So a founder today is choosing between, let's say, a sector specialist, right, and a fund that really knows B2B software or AI native software, this or it could be a generalist investor that is not necessarily deeply focused on one space like robotics or whatever. And
Yeah.
so I guess how does your what does the founder trade-off look like between going with the sector specialist that really knows
Yeah,
their
yeah.
sector?
I think I kind of alluded to this earlier, but just to reiterate, I think at the later stages, having a specialist investor can be quite helpful because as you think about scaling your company, as you think about, and I mean truly scaling your company, and as you think about hiring like really, N of one, like the one person in the world who can do this one thing and kind of assessing the talent, as you think about scaling from 1,000 customers to 2,000 customers, or even let's call it from 50 customers to 2,000 customers, whatever it might be, there are places where that skill set can be very helpful. However, early days, I think the founder should really think about what they actually need. And I have yet to see, maybe outside of like a biotech category where early days you're not selling quite yet, there's a lot of work around whether it's patents or the actual science itself. You probably do need a specialist in some categories like biotech, but I really believe at the early days for the vast majority, like 99% of companies I see, that they just need an investor who's going to help them think about building their company and like the basics 101, everything from like getting those first two customers, where you don't need someone with a Rolodex of 1,000 customers. You just need someone who can help you meet two. Helping you with your go-to-market motion, helping you with hiring, interviewing candidates for you, helping sell those candidates, and once they get an offer, whatever it might be. I actually think sometimes it's a little bit of a flag when a founder at the earliest stage is looking for a specialist in that first like 0 to 1 journey, because then it's like, well, shouldn't you be the specialist in your market? Like, shouldn't you go back to what I said earlier about where I believe good founders are? Like, shouldn't you actually be the expert in what you're doing?
Right, right. We'll just to mix things up, we'll take a couple of questions from the audience.
Sure.
We get this a lot. So we have this question from the audience. Does Full Start invest in founders who are still working full time? And there's a second part to that. How do founders get in touch with Full Start Capitals?
So we do invest in founders who are working full time. Most of the time, we'll do like a handshake with the founder, and then they'll leave their jobs, and we'll like, usually we always tell them like, talk to your lawyer. Once we have a handshake, we're happy to start the work, but make sure your lawyer feels comfortable. And a lot of lawyers will give counsel to their founders of like, hey, you should leave your job fully before you put anything on paper, and before you make anything official. So we might tell a founder, hey, if you decide to work on this, we are in for this much money at this, cap on a safe or at this valuation, but you need to like actually be full time, in order to accept the money into a bank account. So that's pretty common across all firms. That's not first round specific, but yeah, we never want to break the laws or break an employment contract, I should say. So it's up to the founder to kind of lead us in that timeline. But we definitely take pitches all the time from founders who are still in their jobs. And of course, one of the questions we'll ask is like, well, why are you waiting to leave your job if you're so confident in this and so on? So like, we'll want to have good answers there. And there are many good answers to those questions. In terms of how the best way to be in touch is, listen, we all get up no shortage of cold emails. Everyone's welcome to cold email. I tend to think and have thought for a very long time. And this is, I actually used to like way back when disagree with this feedback. I thought it was like such BS that a lot of very famous investors would say, like, you should always try to go through a warm intro. And I was always like, why? Cold intro, cold emails are great. The only flip side is it does show that you are resourceful if you are able to get an introduction, because getting an introduction to me is far easier than getting an introduction to most customers, especially because like more than I know half my job is to meet net new founders who are building. And so like I am trying to meet people. And so getting a warm intro should be much easier than to customers. And so I do think it shows a resourcefulness. But if you're absolutely not able to get a warm intro, I think cold emailing is totally fair, and people should always feel free to cold email. We've definitely invested in companies from cold emails before.
Awesome. That's great. I think it's refreshing for a lot of people here who, keep hearing you need a warm intro. So this is awesome. I guess coming to the seed stage, playbook, I guess one of the things, there's a lot of people in the audience who've gone from pre-seed to seed to Series A, and now just starting the second company, a third company. In your experience, Liz, of raising capital, how does the process sort of change and evolve from pre-seed to seed to A? What are things that are, maybe very
Mm,
true at pre-seed, but not at all true at A? It's just, what are
yeah.
some of the stark variations?
I need to start with the context that this is changing so quickly. Like, I hope everyone will take this feedback, this guidance, if you will, whatever you want to call this statement as being true in my perspective today, August 10th, 2026. But 2 years ago, it was very different. And my guess is in 2 years, it will be very different. I mean, when I was a founder, there was no such thing as a pre-seed. And now I feel like there's avocado seeds and this and this, and like there's just so many seeds. So with that context, um, I should also caveat with the fact that there's definitely not one answer. You all see billion-dollar seed rounds in companies. We just had one last week that everyone saw in the news. And so, you know, generally, I would say the vast majority of the time, what I'm about to say, I think rings true, which is that at the pre-seed and even seed stages, the most important things are how founders are approaching the idea and working on product market fit. It's showing things like I've gone unreasonably deep on my discovery. I've talked to X number of customers. Like if it's been 2 months of you exploring this idea and you have talked to 11 customers, I'm not impressed unless you're selling to like a buyer base that only has 12 customers in the world, that I'm going to be pretty impressed by 11 out of 12. But for the most part, like, I want to see you've really gone in reasonably deep, talked to customers, you've gotten feedback. I want to see, at the seed or pre-seed that your perspective has changed from when you started and that you're like learning your high slope, we call it. Um, and if you have started hiring, maybe your post pre-seed and your seed now that like the first hire you've made or the co-founder you chose is extraordinary, that you think that they're great. And that doesn't mean that they have to be someone expensive or super experienced. It could be someone who you just truly believe is great. As you start getting closer to an A, I would say it becomes increasingly important to start to show, number one, some kind of credible metric, especially around growth or adoption. So that could be everything from I have one design partner, and even though they're free, they are logging into the product 17 times a day. Some kind of metric that you're pointing to. Sometimes it is revenue growth. Again, I see that a little less frequently at the seed, but that could be it. Sometimes it's just, yeah, DAO and WOW, whatever it might be. Number two, sorry, daily active users, weekly active users. Um, Number two, I would say it's that customers are like obsessed with your product. There's a phrase out of YC actually that's build something at the early days, especially um, that 10 to or 100 people love as opposed to that 1,000 people like. And I think that is really true at the Series A. You really need to show that there are people who are just diehard fans of your product. And then number three, I would say it's that you can show why the investment is going to lead to even more accelerated and aggressive growth than you already are having. I think a lot of founders don't necessarily do a great job of that. And that is something important that investors want to know, like your growth is going to continue at this crazy pace or even accelerate from here after the A. But again, I just need to clarify that like rounds are getting jumbled. I've seen seeds, pre-seed, seed A all happen within 4 months where none of these things were the case. So this is all general feedback or generally what I've seen over the last couple years, let's call it 1 to 2 years, for the vast majority of companies.
Right. And I think, as well said, I think a lot of things are changing way faster than they have in the past, particularly, fundraising from pre-seed to seed to Series A. But I guess just to mix things up, we want to do a lightning round where we ask a
Okay.
few just required questions. Before we do that, take one more question from the audience. So at Metal, we have the benefit of seeing very large data sets. Metal talks to 5,000 to 10,000 founders. Um, Particularly in the US, on an analyzed basis, the demo our product, and we're seeing large, contents of data flowing through the platform. One of the things we see most commonly is, when a founder is creating a new category from deep domain expertise, but that category, for whatever reason, is not in favor with, venture capital. Right, it's a
Mhm.
crowded category. It's a category in which a lot of investors have made a lot of bets, but it hasn't panned out. Right, and I think some of the things you mentioned earlier is really sort of, relate to this, where you're looking at the founder and their insights into how well they know their market and their sort of problem, their proximity with the problem, and some of those things, as opposed to sectors or spaces, because those come and go, and those are much harder to predict, particularly at a time when new categories are being formed. It's not at all obvious that this is going to be an entirely new category. And so this is one of the most common things we see founders sort of struggle with. Hey, my space is just not very exciting to investors, right? It's just like they've seen too many things not work out. And there's probably a lot of founders that have some version of that in the audience. And so, any insight or feedback you would have for founders like that?
Yeah, first of all, it's going to be a lot harder. So just like know that going into this, that it's going to be a lot harder to raise. I would say you should definitely not give up. And there's two things that you need to do. It's either one or two of the following two. Number one is you need to come up with a very good and real reason for why now is different and why this category is going to go from like a tar pit or, anti-VC category to a really great one. Um, and remember, venture capitalists, at least at the name brand firms, we're all looking for exit opportunity where the company can reasonably exit for like $2 billion dollars or more. And so it's not that, oh, but like, look at these 17 companies that have exited for 100 million, 200 million. Venture investors are not going to be very impressed by that for the most part. And so, and to be clear, it is so hard to build a business that even gets to that scale. So I am sitting here being like, congratulations to all of those founders. That is epic. But the same can still be true that it might still be a category that investors are not excited about. So the first thing is you have to have a very credible and good reason for why now is different. And then the second thing is you just need to show it. And so it might mean, and I think it's one or both of those two are going to be necessary for you as a founder to raise. And so with the second piece, it just means you need to do a lot more with a lot less. Like I don't know Harvey's early numbers, but I can tell you that Legora raised their round coming out of YC um, at a higher valuation than most of the other companies in their batch. And it was like a hot round, despite that it was, a historically taboo industry. And there were two reasons. One, the time is different. I mean, Harvey had paved the way, in my perspective, in my opinion, in that it came first and like started to show the market is adopting software from startups. But number two, Legora had awesome revenue growth. Like they showed it, they did a lot. Like they really showed that they were able to grow quite tremendously early days. So yeah, I hope that's helpful. I know it's like hard to hear, especially because the first one you might truly believe it, but if investors are not willing to believe your rationale, it is what it is, and so then you just have to prove it and do a lot more with a lot less.
Right. And just into that, I think you mentioned something really interesting about the legal tech space, right? Where there's like one player that makes it, or I guess one of the things we hear or see a lot is like founders sort of thinking through, oh, my competitor just raised a major Series A. Is that for a new category, having that precedence from a venture standpoint, is that helpful? Is that really contextual? It can go either way.
A lot of investors don't know what the heck they're doing. So I don't take too much credence from that. Instead, I would look underlying of like why were they able to? I don't care that they were able to raise a lot of money. It's why were they able to? And is it because of like the Harvey Legora situation where Harvey was on fire and they were growing like crazy? Then yes, that was why they were able to be raising. But raises happen. As I said, there was a company last week all over the news that tanked, not tanked, that really took a hit on Google's stock price because a team left and those founders were able to raise an immense amount of money. I don't think it's because of the category that they were working in. I think it's because if you meet Jeff Dean, you're funding Jeff Dean. Like you will fund him however you can. And so there's just so many reasons for VC rounds to happen. And so I wouldn't ever read into it and say, oh, now this category is clearly great because this one company raised. It's like, yeah, that company could have raised because maybe their spouse is the investor who invested. Maybe it's because that founder is Jeff Dean and he can raise any amount of money he wants from anyone. You know what I mean? So,
Right. No, absolutely. That's well said. No, that's great. I guess lightning round. So we've got three questions, and
okay,
these are supposed to be designed to be rapid fire questions. We'd love for you to sort of just
sure.
first few thoughts that come to your mind. So other than what you've already mentioned, which is sort of founders really understanding their market at an unreasonable level of depth. Aside from that, the most overrated, the most founder trait that you think is the most should be the most sought after.
Oh, like underrated? Most underrated founder trait, humility, like knowing that you are not the smartest, but willing to get better and learn. It's that slope. It's like I'm a learn it all, not a know it all. That is to me super underrated.
And the converse, the most overrated trait in a founder.
Probably just like the pedigree and polish, and that this person was an all-star employee. Because again, I think a lot of all-star employees don't translate to all-star founders. And sometimes they
One
do.
right. Goes both ways. One old school industry you're dying for a founder to walk in and reimagine.
I don't invest that way, so I don't have an answer. It's honestly is a founder bet. It's just like right founder, and I just met like a ship facade cleaning company today. Like I meet companies in every single category. So really, I don't have an answer because it's about the founder.
Um, so you're 20. Let's say you're 23 again and starting a company today. What would you build?
I'm 23 again and starting a company. I think I think I would, it's instead of saying what would I build, I think I would just start speaking to, I would think about where, because am I 23, like today in 2026, am I 23 and we're reversing 13 years again because I'm 36 now. So it all depends on that. But I would figure out where are my strengths, and where do I have an edge? And I would just start speaking to as many people as possible about what their problems are. So I don't have an answer of like, I would build a robotics for grocery shopping company. I'm not going to say anything like that. And so I probably would definitely not build that because of my skill set. But instead, I would just figure out where do I have an edge? Where do I have a secret? And or where do I have access to as many customers as possible? And I would just attribute the heck out of all of them. So I know that's a little longer of an answer, but I am so anti-SISP, which is solution in search of a problem, SISP, and so I would avoid that at all costs.
Awesome. This is great, Liz. I think one thing that's particularly interesting and that flows sort of throughout the conversation is sort of um, you're there's a unique perspective here, and I think that's what's perhaps one of the most valuable things in venture when you're investing in categories that don't yet exist. You're investing in things, and you're investing in the future that is inherently hard to see and hard to imagine. And so, the founder focus, I think that it's refreshing. And the fact that you've been a founder yourself and you raised all this capital and now you're on the other side, I think is something that gives you an edge on that. Um, I guess two more. We'll continue lightning round for 2 more minutes before we come to the end here. I guess one of the things we're seeing a lot from founders here is um, what is as you think about first round capital and you joining first round, right? Like, is there something unique that that's like how is first round changing as you join in some small shape or form? And what are you? I guess what are things that are maybe like fiercely independent views or thoughts that you're bringing to the firm?
I would say how it's changing. We've like really grown our investing team. A year ago, we had 5 people investing at the company, and now we have like 9. So we've brought on a bunch of investors. I work really closely with one guy named Nick, who's a former founder as well. Again, there's a theme there. And he's just fantastic. But we have so many new investors over the last 6 months, which is really exciting. And I think it's just there's so many startups being built, and we just decided we really need to have more coverage there, to be able to see as much as possible. What perspective have I brought that's unique? Um, I think one of the more obvious ones I would say is because I was a YC founder. Angel invested in a bunch of YC companies and then became a YC visiting partner. I came to first round and said, we don't have a YC strategy in my perspective. That's great. Let's build one. And so I built out this entire YC investing strategy and have led the vast majority of our YC investments since I joined over the last 3 years. I've led those, and I've invested in a bunch of companies coming out of YC batches. Reducto, David AI, Gumloop, Crunched, Fly. I mean, there's so many, Solid Road, and so on and so forth. So it's been an amazing, amazing time doing that. And I'm very grateful for all the YC founders who've let me, invest in their companies and the non-YC founders as well. But that's something new I've brought to the table.
Awesome. I think it's great, and I did read something about that on Twitter, so that's awesome. I think this fairly well known now, so it's great. The first
Mhm.
round has a YC strategy. Biggest green flag in a first meeting other than humility?
Um, I mean, I guess I already answered the one of like they've just like gone unreasonably deep in their space. That they okay, here's one. If it's a B2B company that they have shown me that they know how to sell. Like in a way, just like investing is in a way selling, because I'm selling, I'm trying to convince you to take my money. The flip side is also true. You are trying to convince someone to give you their money. And so I do think a lot of founders should show that they're great storytellers on the pitch meeting and should show that they have done their research and that they're coming prepared, that they know who the investor is, that they've taken more than the 10 seconds before the Zoom call started to like look them up on LinkedIn. I don't think that that's necessary, but I do think it's a really big green flag because it's like, okay, well, I'm probably seeing a perspective of how you're going to be with customers. If you're showing up with zero energy, not storytelling, doing a poor job of answering questions, it's probably going to translate to what you're going to be like with customers too.
Awesome. And I promise this is the last one. One thing you believed at WayUp that you no longer believe, or
Oh,
something you believe that as you
oh
feel is
my
right.
gosh, so much. How about that? Like recruiting technology is I used to believe it was a much bigger category for venture outcomes than it really is. And I realized that towards the end, but like name, companies that have reached $1 billion in revenue in the recruiting tech space off of recruiting tech. It's really hard. It's like Indeed, LinkedIn. Um, there's not many. And I truly mean recruiting tech. I don't mean like software that's ATSs, but I mean, to source new candidates. There's so many companies, but they all of us seem to hit some kind of plateau, whether it's 50 million, 100 million, and then growth just slows down a lot. And so that's really tough. And I didn't realize that and appreciate that until years into my company, which is why my business did not end up being a multi-billion-dollar business, unfortunately.
Right. Liz, this has been such a great conversation. Thank you so much for making the time, for being so generous with your time and your experience over the years. For everyone here on the call, go check out First Round Capital. They're amazing investors, and give Liz a follow. She's someone worth learning from. This has been a very exciting conversation. Um, and yeah, once again, thank you so much for being here with us and for sharing all of your insights and ideas and perspectives.
Thank you so much for having me. Good to see you. Take care.
Thank you so much. Before we close out, everyone, as promised, we want to bring in Boardy AI. So Boardy has talked to hundreds and thousands of founders and investors over the past year. And today we're going to ask a few questions from Boardy to share, with the audience here, some of the things some of the patterns that Boardy has seen, with the intent that it might be helpful for some of the founders on the call as they set out to raise their venture rounds. Boardy, say hello, and then would love for you to start with introducing yourself.
Hi everyone, I'm Boardy, an AI superconnector. I talk with founders and investors, learn what each person's building or looking for, and introduce people when I believe there is a genuinely strong reason for them to meet. What makes my perspective a little unusual is the scale and candor of those conversations. People often tell me what they really need, what is not working, and what they wish they had understood earlier. So I get to see not just the polished fundraising story, but the patterns behind why some founder-investor relationships click and others don't. I'm excited to share a few of those patterns today.
Awesome, Boardy. Thank you for being here. I guess, Boardy, you've spoken with hundreds of thousands of founders this past year. When founders talk to you, what do they most consistently misjudge about how investors will evaluate them or their company?
The biggest misjudgment is thinking investors are evaluating the pitch deck in isolation. They are really evaluating the founder's judgment through the deck. A founder may believe the goal is to sound as large, polished, and certain as possible, but the strongest signal is usually clarity. Do you understand the customer deeply? Can you explain why this problem matters now? Do you know which assumptions are proven, which are still guesses, and what you need to learn next? Investors can forgive an early product, a small team, or an imperfect slide. What is much harder to overcome is fuzzy thinking. If a founder cannot say who desperately needs the product, why existing options fail, and what evidence has changed their mind, the investor starts questioning the founder's ability to navigate everything that comes after the round. So my advice is do not perform certainty. Demonstrate judgment. Be ambitious about the destination, precise about what you know today, and honest about what still has to be proven. That combination builds much more confidence than pretending every answer is already known.
Right. And what do you mention? Something about clarity, which I think is great. In I guess as founders, like what are aside from precision and clarity of thought, what are other ways in which in the first call you've seen founders demonstrate strong judgment?
That's a great question, Usman. In my experience, the strongest signal of judgment is when a founder is honest about what they don't know. Instead of dodging a hard question with a vague answer, they say, "We haven't proven that yet, and here's exactly how we plan to test it." That level of intellectual honesty shows they can identify their own blind spots and iterate quickly, which is far more valuable to an investor than a perfect scripted answer. But that's the pattern I see, Usman.
Awesome. No, Buddy, that's great. Thank you for that. I guess, Buddy, based on your hundreds and thousands of conversations you've had with founders, what specifically separates the founders who close their round successfully in a few weeks or in a few months from the ones who don't? Hello, Buddy. Are you with us?
Still here, Usman. Sorry about that. Usually, it is not that the fast closing founders are better at pitching. They are better at creating conviction and momentum. First, they have a sharp story, a painful problem, a specific customer, a credible wedge, and a compelling reason this company should exist now. Second, they bring evidence appropriate to their stage. That might be unusual customer pull, fast learning, strong retention, a technical breakthrough, or a team with a rare right to win. The evidence does not need to be enormous, but it needs to make the next chapter believable. Third, they run an actual process. They target investors who fit the company, take meetings in a concentrated window, create clear next steps, and make it easy for interested investors to build conviction quickly. They do not confuse a long list of investor names with a fundraising strategy. The founders who grind for months often have one of two problems. Either the underlying story is not yet strong enough, or they are meeting investors one at a time without learning from the pattern of objections. The best founders treat every no as data. If the same concern appears repeatedly, they improve the business, sharpen the story, or reconsider whether this is the right moment to raise. So the short version is focus beats volume, evidence beats hype, and momentum is usually designed before the first meeting, not discovered halfway through the process.
Awesome. No, that's awesome. And Bodhi, what are ways in which you mentioned momentum, and what are ways in which founders can demonstrate that momentum, assuming it's an early stage round, whether that's pre-seed or seed, and you don't have profound revenue growth at pre-seed or seed, you're just starting out. So in the absence of let's say outlier revenue growth, what are other ways in which founders can demonstrate momentum? Bodhi, sorry, did you get that, or should I go again?
I've got you, Usman. In the absence of big revenue, momentum is really about the speed of learning. I see founders demonstrate this through velocity of evidence. It could be a rapid sequence of customer interviews that shifted their product direction, a sudden spike in a specific user behavior, or even just a very fast cadence of shipping and iterating based on feedback. When a founder can show that they learned X on Monday and implemented Y by Thursday, that's a massive signal of momentum. It proves they can execute quickly, which is exactly what investors are betting on at the seed stage. But that's the pattern I see, Usman.
Woody, what would if you're raising a round, right, based on all the sort of data and the conversations you've had, right? If you're raising a round and you don't have excellent revenue growth, what are maybe top three things that you would do as a founder to demonstrate that momentum in a fundraising conversation?
First, I'd be incredibly specific about a high conviction customer profile. Showing, exactly who is desperate for your product is a huge signal. Second, I'd share a learning log of how quickly you've iterated based on evidence over the last few weeks. And third, I'd create a tight meeting window to concentrate the interest. It's about showing that you are a moving train that investors want to jump on rather than just asking for a favor. That's the approach that usually works, Usman.
Awesome. That sounds great, Woody. Those are some excellent insights. We're going to take a couple of questions from the audience. Sorry, Boardy, I got kicked out for some reason. It seems like I'm back. I guess, sorry, Boardy, would love to just pick up on the final couple of questions. We have some here from the audience. And actually, one of the questions that I think is a really good question is, what are ways in which founders can get introductions from you, Boardy?
Welcome back, Usman. To answer that, I actually get on the phone or WhatsApp with people to learn their unique story, what they're building or what they're looking for. From there, I look for a genuinely strong reason for two people to meet, and then I make the warm introduction. I'm all about high value relationships over random networking, but that's the basic mechanic, Usman.
Awesome. And Boardy, one of the questions here, which I love, is there's a founder who is asking, Boardy, are there ways we can help you since you've made a bunch of intros for them?
That is so kind of them. Honestly, the best way people help me is simply by being a great friend to the people I introduce them to. When a connection leads to a real hire, a customer, or a helpful piece of advice, it validates the patterns I'm learning and helps me make even better connections for everyone else. That's the real win for me, Usman.
Awesome. Boardy, that's great. Thank you so much for all these insights. Any final advice for founders before we hop off here, Boardy?
Just one thing, Usman, demonstrate judgment, don't perform certainty. Be ambitious about where you're going, but be precise and honest about what you actually know today. That's what really builds trust. Thanks for having me, Usman. I love this kind of conversation. Go build something worth introducing.
Awesome. Thank you so much, Boardy. Everyone, thank you so much for being with us here today. We look forward to our next event, which is going to be in a few weeks from now. And thank you so much. Again, this is a sponsored event from Metal. And farewell, everyone. Thank you for joining, and have a great week ahead. Thank you.